In just a matter of hours following some new developments, Wall Street went from panic sell to panic buy, especially in your small caps. The Russell 2000 at the time of recording this video is up about 2.3% today and did most of this gain in just about 2 hours. And this new development today really validates what Tom Lee has been saying for weeks now, really months, about small cap stocks. It was actually the GDP growth rate. So you came in at 2.8%. The estimate was about 2%. This was a big beat to GDP. And if we are truly heading into the Fed that's going to cut rates 3 times this year, well, you need the backdrop of the economy remaining strong, because that means the Fed is cutting because inflation is falling, not cutting because the economy is weak. Normally, the Fed cuts because they're forced to, because the economy weakens. That's why you rarely ever get quote unquote soft landings or no landings, because typically the Fed only cuts when the economy weakens, and typically the economy weakens as the Fed starts to and does raise rates. But apparently that's not happening. Now, as I've said many times here on this channel, the kryptonite for small cap stocks specifically is the economy, because they are cyclical to the economy, meaning small caps tend to do well when the economy is doing well. They tend to do poorly when the economy is doing poorly, but they are also very interest rate sensitive. So it's almost like you need both of these things to work in conjunction for that outsized gain. You need the economy to be strong, and you need the Fed to start lowering rates. If you get that setup, which today validates at least one portion of that, the economy staying strong part, you could be off to the races in small caps and see a rally in which you have not seen in many years. Tomorrow, we will get more information that could validate the inflation falling part of that setup, I guess. I don't want to call theory, but setup coming tomorrow morning. I will share that with you in Wall Street's estimates in just a moment, but I think you need to take a listen to what Tom Lee just said on CNBC this morning.
And I think you're going to give us a little bit of that today for our wounds from yesterday, but not entirely, because you think the S&P is probably going to be flat for August overall.
Yes, that's right.
And that's unlike some of your recent calls about the S&P with friendlier inflation data. You've made some calls about some big near-term moves. That's not what you're saying today, unless you're talking about small caps.
Yes, that's right. I think part of what we saw yesterday was, the rotation that's painful away from large caps. And I think Tesla earnings and Google sort of accelerated some of that. And I think there's been some uncertainty about the Fed's commitment to cutting, even though we expect inflation to fall like a rock. But when the Fed starts cutting, that's good for small caps. And there has been, I think, overseas, some unwind of that Japan carry trade that's hurt the NASDAQ. But to me, this is why the S&P had a great first 6 months. Maybe it needs to consolidate those gains. But now Russell 2000 has an 11 median PE, earnings growth 800 basis points faster. And, it just posted 11 days where 10 out of 11 days had a 1% move. The 9 times it did that since 1979, when you weren't in a bear market, we were up 100% 1 month, 3 months, 6 months, 12 months later. 12-month average gain 40%.
You're very popular, and I would warn you this is not good that you're saying this. You think this rotation has been driven by expectations of a Trump White House? Is there another way you can say that? Can you come up with something else so you don't have to delve into the political side? You think Trump's going to win the White House, or you think the market at this point thinks he's going to win the White House?
Yes, it's the second.
Okay.
Betting markets are putting a 65% probability of a Trump White House. The biggest beneficiary, which is deregulation, M&A, regional banks doing better, that's small cap stocks.
Okay, so that's the linkage that you're seeing then. So you really think we've seen a Trump trade, and even after, the betting markets have moved somewhat. He's come down. Vice President Kamala Harris has moved up a little in the betting market since the weekend when the news came out. You still think that that's at play from here on, not just to explain the rotation that we've already seen? You think it's going to continue? That's
right. So I think it's from this point forward, there's a lot of opportunity in small caps. Part of it is that there's a lot of overlap. When the Fed cuts, That's lowering cost of money. That's good for small caps and the regional banks. It probably boosts CEO confidence, which is M&A, and that benefits small caps. So there's a lot of overlap between a Fed cut imminent and a Trump White House, and that's why I think the interplay is positive for small caps.
Interesting. So
I still don't understand. You don't think the large caps are done. You just think it's a slowdown for the S&P 500 on a broader level?
Yes, that's right. I think the Mag 7 was very attractive at the start of this year because growth was scarce and they've had great visibility. And they're not expensive. 27 times earnings isn't demanding. But now that there's a visible catalyst for small caps, I think investors are taking some profits up. NASDAQ was up 20% and putting it into small caps.
I mean, I don't know how you guys feel, but Tom Lee tends to be correct. Now, this latest call for a 40% rally over 10 weeks has been a pretty aggressive call, and so far, so good for Tom Lee's recent bold prediction. Tomorrow is going to be very important in validating just that. Because tomorrow we're going to get core PCE price index month over month. This is the Fed's preferred measure of inflation. Last month you came in at 0.1%. We are expecting 0.1% again. But I do want to preference you in saying it's not just this headline number that really matters. That's what people kind of look at initially, but it does get rounded down to an actual smaller decimal. So for an example, with the CPI report we had 3 or 4 weeks ago, we were expecting 0.21%, which would have gotten rounded down to 0.2%. We got 0.06%. So that got rounded up to 0.1%, but that was pretty close to being rounded down to 0. Okay. So for tomorrow, if we're expecting 0.1%, you could come in at 0.15%, 0.15%. That would actually be a very good number, but it would get rounded up to 0.2%. You could come in at 0.06%, the same as the CPI report a couple of weeks ago, and you would still get rounded up to 0.1%. But obviously, the 0.06% number is much better than 0.15%. So I do just want to preference you with saying that. Now, you could also come in at 0.19% and get rounded up to 0.2%, but that's a really, really bad number compared to expectations. Now, if you take a look at the last couple of months for PCE month over month, this is the period that the Fed kind of got a little bit concerned because we were coming in at 0.1, 0.2 pretty consistently from July until December of 2023. And this got the markets very excited. This was the last big rally we had in small caps. And then you came in at 0.5%, 0.3%, 0.3%, 0.3%, 4 months of really bad PCE data. And then last month you came in at 0.1%. Now, we're expecting another 0.1% number. This will be 2 months of better than expected core PCE. This will really validate the Fed that they can start to cut rates. Now, the markets are already ahead of them. They're already saying, yeah, the Fed's going to be cutting in September for sure. And we'll take a look at those probabilities here in just a second. But if this report does come in better than expected, hopefully with a lower than expected actual number, you're really going to start to put on this small cap trade, considering the GDP report that came out today. I think, in other words, if PCE comes in lower than expected tomorrow, you could have a massive day for the Russell 2000. Like a 5% day would not surprise me for the Russell tomorrow. But at the same time, remember what happened with the CPI report that came out a couple of weeks ago. That day, the Russell had a massive outperformance. The Russell was up close to 4%, and the S&P was down over 1% because big tech got sold off. Because, again, what Tom Lee just said, that's where the growth was. Growth was scarce at the start of this year. There were pretty low expectations for other parts of the markets, especially your small cap stocks. And big tech is kind of seen as that defense trade, that safety trade. If we are going into a recession, perhaps Nvidia is going to do better than a small cap stock. Perhaps Microsoft or Meta or Google are going to do better than small cap stocks. But if there's no recession as per the GDP data this morning, and inflation comes down, and the Fed can start cutting rates, I see no reason why big tech would outperform. So in fact, you could see another repeat of the CPI report that we just got a couple of weeks ago, where big tech sells off and small cap outperforms. And then it's going to be a lot harder as well for Wall Street to say that this small cap rotation is just short-lived. Now, yes, I think today did a lot to really reaffirm this rotation into small caps is viable and going to continue for a while. But you get the Fed's preferred measure of inflation, PCE, coming in lower than expected as well tomorrow. Yeah. And you're going to get a lot of people that seemingly overnight are going to become way more bullish on small caps. I mean, how would you logically, as a quote unquote sophisticated Wall Street investor or fund manager, say small caps don't look attractive with 2.8% GDP and 3 expected Fed cuts by the end of this year? I mean, you should be fired if you are a professional money manager and rebuke small caps in that environment. Especially considering, like Tom Lee said, small caps are expected to post 8% better EPS growth than the S&P 500 for this quarter. And really over the next 2 years, you're going to outgrow the S&P. I do defer a little bit with Tom Lee because I do think if we get a lower than expected PCE report coming out tomorrow, that's going to be negative overall for the S&P because of your mega cap tech that would likely get sold off. And I do think the political uncertainty will start to affect the S&P a little bit more in the month of August as well as in September. I think you're still likely going to get more downside, not necessarily just an S&P that is flat. But I do think the Russell can do very well, even if the S&P sells off or goes through a correction. In fact, with the data that we got today with the GDP report, with potentially a lower than expected PCE report tomorrow, you could actually start to look at the Russell as a safety trade, as a hedge to the broader markets, which I know that sounds crazy, but the Russell really comes down to what's the Fed doing, and that's looking to cut rates here in about the next month and a half or so. What's the economy doing? Economy strong, Fed cutting rates. I mean, seriously, what's there not to like? Now, again, I'm not a financial advisor. I'm not a financial planner. Do what you guys want to do. I think cash is probably the best bet here. If you don't want to bet on small caps, I don't blame you. The historical precedence is small caps usually outperform for a period of time and then they underperform again. I understand, but it's hard to make a bearish case for small caps. And without the Mag 7 being where they are, I would call them pretty expensive relative to what the growth is actually going to be. I even think the S&P on an equal weight basis looks pretty attractive here with the backdrop of lower inflation and a stronger economy. The markets are currently implying a 7.2% probability of a Fed cut coming July 31st. That is next week. A 92.8% chance of no action from the Fed. Now, September 18th, you're pricing in an 89.1% chance of 1 cut and 10.7% chance of 2 cuts. Actually, 0.3% chance of 3 cuts by September. That would be absolutely insane. Let's just say that. But the PCE report coming out tomorrow, if it is lower than expected, will probably raise the odds of a July 31st cut, which again could help support your small caps. Now, by the end of this year, by December 18th, you're pricing in 3 rate cuts with a 53.5% probability, and 2 cuts is priced at 36.9% odds. So I think tomorrow will be a very critical day for this small cap rotation. If CPI or PCE comes in a little bit higher than expected, I would expect the Russell sells off a bit. I would expect mega caps can do a little bit better with that kind of backdrop, but I still wouldn't think the Russell trade is over with, but it would take a little bit of consolidation. So let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already and you made it to the end of this video. Hopefully you learned something or gained some greater market perspective that will hopefully help you make more money. You guys, most importantly, enjoy the rest of your day, and I will see you in the next one.